Pankaj, thanks so much for taking time out. Just going by the kind of exceedingly volatile moves that we've witnessed in the broader markets from the March lows. First, we've seen a meteoric rise, and then yesterday, for instance, things were clearly shaken up. Is that an instance of the direction that the broader markets are headed in?
Yeah, morning, Aman. I think so. We've had a phenomenal rally in the last 6 months. So probably a correction was much warranted, or probably uh, 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 better late than never. And I think it's a healthy correction for the market because there are pockets of markets where we've seen stock prices have clearly run ahead of fundamentals, and there's been a fair degree of exuberance or froth, if I may say so, in mid cap, small cap space. So I think a correction is much warranted. Aggregate markets are still reasonably priced. Index, if you look at the Nifty index, trading at about 20 times current year earnings, is reasonable in the context of the kind of earnings growth, strong earnings growth that we are witnessing. So I think from here on, much of the gains on the indexes are done, and markets will be more stock specific in that sense. And I think some correction at this level is pretty healthy for the medium term health of the market.
So, Pankaj, what is the opinion then on the various individual segments, right? And let's pick up what's happening in the railway and the defense names. Frenzy in the market. We've seen phenomenal returns. We were just chatting with Vineet Samre as well from DSP as to how about a year back you bought a bunch of these stocks and you're sitting on very, very handsome returns. But now looking at how frenzied these spaces are getting, the RSI levels, the growth story, etc. Do you think the best is already baked into the stock prices? And for those now feeling FOMO and wanting to catch in on the ride, would you say stay put right now is not the right time?
Absolutely. I think while the opportunities or the outlook for both defense and railway is very constructive, and both of them, to my mind, are a decadal story. So India's whole path of indigenization of our defense imports. India is the third largest spender on defense globally, and the path that India is taking, where we want to reduce our export dependence and produce more in-house or within the country, and probably become a defense exporter as well to some extent, effectively means very strong growth for companies in the sector. And likewise, railways are on their one of their biggest investment cycle, which railway has not done in their life. Their investments over the next 5 years are at about 10 trillion. 10 trillion is 3x of what they've done in the last 5 years. So I think from a opportunity perspective, sector opportunity perspective, the opportunities are very large and probably very long term. Having said that, I certainly believe from a near-term perspective, stock prices are more than pricing in the next few years fundamentals, and clearly stock prices are ahead of fundamentals in that sense from a near-term perspective. And for someone who's investing into these stocks, I think it's not a bad idea to take some money off the table, because stocks have moved very significantly. We've seen gains which are like 200, 300, and 400% in these kind of stocks over the last 9 to 12 months. And obviously, for new investors, I understand that having the feeling of FOMO, but I would still advise them that they should hold back for a while, because it's certainly not a good idea to participate in this kind of frenzy when stocks have gone up 3x, 4x, and then jumping into it. I think there'll be days where you can buy, or opportunities when you can buy these stocks at a better prices than what they are at today.
Give me an example of what is there on your radar. You said, look, I wanted to buy them, but the run-up has been too sharp. I have time. I'll wait for my entry points, but I'm clear I want to buy them. What would fall in that category? Buy on decline, but a must buy.
So we like the whole capital goods space, Nikunj. We have been significantly overweight the entire capital goods space, which includes defense and railways, because they are part of the whole investment cycle over the last 18 months. And most of these stocks have done exceedingly well. And the good thing is that after almost 10 years, we're seeing a revival in India's investment cycle, where all three segments are firing. So public investments or government investments have been strong over the last 10 years. But the good thing is, over the last few years, we have seen revival of private sector capex or investments, and we've seen revival of household investments with the revival of the real estate cycle. So let's say, for example, we have exposure to stocks like ABB, Siemens, Cummins, some of these defense names as well, including Bharat Electronics, BML, Hindustan Aeronautics. And all of these stocks have done exceedingly well. But clearly, if you ask me over the next 24 months, I think therefore next 24 months earnings prospects of growths are clearly priced into these, because these stocks have seen significant or massive P re-rating over the last 12 months, I would say. And now they are probably at the other extreme in terms of valuation or optimism. So while all of these stocks have probably long-term compelling growth opportunities, but I would suggest that investors should hold back and probably wait for a more appropriate or attractive price and valuation levels to get into these names.
So where do you think the pendulum has swung in favor of greed, and where do you think the pendulum is still somewhere in middle? There's nothing in the fear category, right? So I'm taking that officially away. The options are where the pendulum is in the center and where it is in the greed category. Sasta to kuch nahi, right, Pankaj bhai?
I completely agree. And see, we need to acknowledge the fact that we are in the fourth year of this bull market. It's a fairly matured bull market now. So when you're playing, meaning this bull market, to my mind, has passed its mid-cycle. So we're in a matured bull market. In a matured bull market, it's difficult to find stocks cheap on an absolute basis. What you can find cheap is on a relative basis. You find stocks cheap in early stages or early cycles of bull market, but this bull market is now fairly matured. So you're absolutely right. One has to look at value from a relative perspective. In that sense, clearly, IT and pharma clearly look the sectors where valuations are far more reasonable, because both the sectors have clearly underperformed over the last 2 years. And because of that, valuations are moderated. Good thing is headwinds in both the sectors are behind. We are seeing in healthcare or pharma, we are seeing earnings growth coming back very strongly this year onwards. So pharma companies and aggregate as a sector will deliver strong earnings growth starting this year. And likewise for the IT, I think the worst of the headwinds are behind. And from second half of this year onwards, we'll start seeing growth coming back to the sector. So clearly, from a relative basis, we find much more value in IT and pharma. And we are clearly taking money off some of these sectors which have done exceedingly well over the last, let's say, 18 months, which is essentially financials and capital goods, and putting that money to work into IT and pharma.
You've not sold Zomato, you've not sold Paytm, you've not sold Tata Motors. I just want to get it right, because these are three stocks we've discussed with you like a couple of times in the last 6 months.
Yeah, we continue to own all of them. Just that now that stocks have moved and to some extent, meaning some of those undervaluations have normalized. We're not investing more, but we continue to own. For us, these are like holdings probably which we would like to own over the next 5-10 years, and probably these are core holdings. So irrespective of the price movement, unless there's some fundamental change in the business, we are not trading these holdings.
You know, Pankaj, since you track the IT space closely, and that's clearly being looked at as one of the defensive bets, where within IT would you buy? Would you stick with the large cap service providers, or would you look at quasi AI plays, etc.?
So we certainly like IT services company where we are invested into or buying into a combination of large caps, which is tier ones, and some of the select mid caps one where we think growth can be much higher or significantly higher than the aggregate sector growth. Smaller companies, because of smaller size, if they have right product portfolio, and these days in smaller companies, CEO change or the CEO plays a significant role. A lot of smaller companies have undergone a CEO change where they've got a new CEO who comes, who's much more dynamic and much more aggressive in driving growth. So we like those kind of stories because they're investment ideas, because there is a catalyst of changing growth trajectory of these companies over the next 3 to 5 years. So we like some of those mid-cap IT companies as well. And apart from that, when it comes to AI, I think some of these IT services companies will, in fact, actually become the biggest player on AI, because eventually every business in the world will have to implement AI tools and models. Any business who would not do that will risk their survival 10 years out. And now for that implementation, it is the same set of IT services company which will do the implementation for clients. So I think IT will become a very big growth driver for IT spends and for IT projects, and Indian IT companies will be a big beneficiary of that.
There are a lot of companies where CEOs have changed. Which
Yeah,
are the
we've
ones you
seen
like?
that.
Because a lot of companies CEOs have changed, and a lot of so what do you like within that CEO change theme?
So we like Birlasoft. They've seen a CEO change about 3 quarters back. We think the new CEO who's in charge is clearly very driven, and we think, given the background and track record he brings with him, he can clearly change the growth velocity and growth trajectory of the company for the foreseeable future. Likewise, Tech Mahindra is undergoing a CEO change after almost 20 years. Now, for a large IT company to undergo a management change after such a long period of time, I think is not a bad idea, because companies do tend to build some flab and muscles, and you need an outsider to come and cut that. So I think it's not a bad idea in that sense. And likewise, some of other companies are also have undergone senior management change, where we are, engaging with the new management to get a better idea and perspective on the thought process of the new management before we take an investment call.
Thanks so much then for joining in and giving us your view on the markets and your advice.